Tax Day, April 15th, is just about 2 months away, so it is time to get ready. And this year, there's some new ways to save real money on your tax bill. Mellody Hobson, our financial contributor and president of Ariel Investments, stopped by to tell us some of the most important new deductions. The big headline, it seems to me, is that, so many people don't itemize, but many probably should.
It's so interesting. Kiplinger's did some work on this very issue that really was surprising to me. So 85 million Americans take the standard deduction, and those deductions are worth $500 billion. But 46 million of us itemize, and those deductions are worth $1 trillion. So fewer people get a much bigger bang for their buck, which shows that itemizing actually has some benefits.
There are some newer deductions just this year.
Yes. So first of all, let's talk about work. One of the things the government realized is 15 million Americans are out of work, even though, thank goodness, that number is dropping slowly. But they wanted to help out as much as they could. So one of the things they said, the first $2,400 in unemployment benefits that you get are now tax deductible if you itemize, which is great. In the past, you paid taxes on the first dollar of unemployment benefits that you got, so that's a big change. Additionally, if you're looking for a job in the same industry, you can make some deductions. You can deduct everything from fees for an agency that might be helping you, anything you might be doing for resume prep, driving to job interviews, you can itemize and deduct that, even postage stamps to mail your resume. That's as long as those costs represent more than 2% of your adjusted gross income.
And so many people in the last year took advantage of this home buyer tax credit, and now that's being expanded.
That's right. So, and that might lead to some snafus because there was a change in the fall. So 1.4 million people have already taken advantage of that first-time home buyer tax credit, which allowed you to get a credit of up to $8,000 depending on your income. Last fall, in order to continue to juice home sales, that program was expanded, and it included long-time homeowners. So now you could be a person who owned a home, you buy a house, and you can deduct up to $6,500, which is terrific. Again, there are some income constraints. There are some other deductions out there if you itemize as well. For example, if you pay mortgage insurance premiums, you can get a deduction, but that deduction goes away next year, so definitely take it this year. Or if you've weatherproofed your home, you can deduct up to 30% of the cost, with capped at $1,500. And again, that deduction goes away next year, so you want to do it this year.
But you also have to be extra careful because there are some common mistakes that just about everyone makes at one time or another. They can really hurt you.
Okay, number one mistake: when you file your taxes, not putting your Social Security number on the document or mixing up the digits. That's the number one thing the IRS says happens, and it makes your filing null and void. It's as if it never got there, and certainly would slow down any refund you might be owed. Secondly, not signing your tax return. And if you co-file with someone else, making sure you both sign. Very, very important. It's like trying to cash a check without endorsing it. And then last but not least, just double and triple checking all of your math, especially if you don't e-file or use tax preparation software that checks your math for you, because the IRS has now said last year they hired between 5,000 and 7,000 new auditors to make sure everything's perfect.
Well, you don't want that to happen.
And this year they're hiring another 5,000 auditors to hunt down money that they believe that they're owed.
So bottom line, pay attention to the details. Mellody Hobson, thanks very much. We have these tips plus 3 more on our website at abcnews.com.